Welcome, welcome, welcome. How is everybody doing? Hope you are doing well. Andrew Kuhn, Focused Compounding. Thank you so much for tuning in with us here today on the video. Today we're going to be dedicating this video to going over the first 4 things that need to be checked for Geoff and I to be interested in a company. This is our first initial checklist. If it doesn't check these boxes, we just simply put it in the garbage, the too hard pile, whatever you want to call it, and move on to the next business. So at the heart of everything we do, obviously, if you are familiar with the podcast or Twitter or our philosophy, everything needs to be overlooked. In this overlooked bucket, we define or we put spin-offs, microcaps, illiquid stocks, illiquid microcaps, international stocks, stocks emerging from bankruptcy, stocks that are controlled by their founder. Really just a group of stocks that for one reason or another tend to go overlooked by the market. They're a little bit more obscure, and we think it's a good place to fish for value, which obviously is the #1 rule of fishing. Fish where the fish are. So today we're going to be demoing out a stock called Parks America. This is a stock that I actually just wrote up on the website. You can get it the first 1,000 words at FocusCompoundingGazette.com. If you want to read the remaining of the post, you have to go to FocusCompounding.com and be a premium member, which is $60 a month. But if you are interested in getting that, definitely go to the Gazette, at least for the first 1,000 words. So is the stock overlooked? The market cap of this company is $10.4 million. And the enterprise value is $9.6 million. So right off the bat, it is a microcap. We're interested, right? This is a, microcaps tend to go overlooked by the market. This is not only one of the smallest companies that I've ever looked at, but also economic-wise, the business is fantastic and definitely one of the best smaller companies that I've looked at. So Parks America, they operate in Georgia and Missouri. The subsidiaries under them are Wild Animal Safari. So they're literally a safari that you could drive through, you could walk through, you could pet the animals. They have over 1,000 animals. They actually, in the Missouri park, just got a baby giraffe. They have wolves. So very exotic animals, and it's very popular in the 2 areas. They operate in a pretty rural area, which is interesting. Actually, in my thesis, I think that a lot of the people that go to these parks are from the surrounding areas. You can go into my write-up to read a little bit more about that, but it's overlooked, right? So it's already a microcap, so we're already interested. We get really interested, and the first thing that we always do is we see how much of the shares actually turn over. Is it illiquid? And upon doing that, we found out that 4% of the shares are traded yearly. And the way that you get that number is you could go to Yahoo Finance, you could find the average daily trading volume, multiply that by 252 trading days a year, and then divide that by the shares outstanding, which they have 74 shares outstanding, and we learned that only 4% of their shares actually turn over. And to put that, I guess, in perspective, Facebook has 177% of their shares turn over a year, and Apple 148%. So this is very illiquid, it's very overlooked, it's a microcap. This is actually the smallest company that we've ever looked at, like I said. The smallest company that we currently own is probably right around $300 million. So we're not just microcap investors. But this stock is definitely overlooked. So it's overlooked, so we could check that off. Next thing we want to make sure is that it's a high quality company. Is it durable? The business has been around since 1991. They grew in the recession. You could pretty much bet that technology isn't going to kill this company. 10 years from now, people are still going to want to go and visit the animals. It's a fun family event. If you actually read the TripAdvisor reviews for both parks, they're fantastic. So that's it's a very high quality business. The EBIT margins, go back and get, one of the things we do is go back with all the data that we could grab on the internet, see what the EBIT margins are. What's the free cash flow generation? The free cash flow margin on this company is 19%. So again, for a $10.4 million company, this business is very great economically speaking. And the standard deviation on that free cash flow margin over time has only been 10% with a coefficient variation of 0.49. So this is a very stable, a very predictable business. When valuing a company, obviously you want to stick to simple, predictable, free cash flow generative businesses, and that's what Geoff and I definitely look for. Next thing is we want to make sure that the stock's CAGR works over time. This is something a lot of people are surprised that we do, but one of the first checklists is we go back and we see how the stock has performed in its history. So in this situation, I think the first time it was traded maybe it was 2005 or 2006, and we want to see what the company's done. So we take a long-term stock chart and we see what the CAGR is on the price, and then we also do a 1 year, a 2 year, a 3 year, a 4 year, and a 5 year. You want to make sure that the company works over time, especially in Geoff and myself's case, because we are so concentrated. So that is a checklist item that we have. And then finally, is it cheap? And it's trading at a price to earnings of 8, EV to EBIT of 6 times, and then a free cash flow yield of 15%. That's very cheap. Now, from here, I want to learn a little bit more about the business, and this is when I actually take a deeper dive. And speaking about cheapness, which I wrote about in my write-up, in 4 to 5 years, I estimate that more than half of the market cap is going to be in cash. So it's an incredibly cheap company. It's a great business. I write about why it's a great business, why it's durable, why the business is going to be around in 10 to 15 to 20 years. So this is definitely a company that you guys want to study. But that's not the point of the video. The point of the video is just the 4 checklist items. Maybe you could take something away from it, but we look for, is the stock overlooked? Is it a high quality business? Does the stock's CAGR work over time? And then is it cheap? And then from there, we take a deep dive. So I want to thank everybody so much for tuning in. Like I said, we are going to be pumping out 3 videos a week, so make sure you hit that subscribe button. That will notify you when I post a video. Also give me a thumbs up as well if you enjoyed the content, and we'll see you in the next video. Take care.